Well, India's largest online aggregator, Indiamart, reported a strong set of numbers in the first quarter of financial year 2020. Now, the revenues of the company were higher by nearly 30% compared to last year, while in this quarter, the company reported an EBITDA profit of nearly 37 crore rupees as against an EBITDA loss last year of close to 53 crore rupees. To help us decode the quarter gone by, joining us now on the show is the MD, Dinesh Agarwal. So, sir, to start off with, what led to such a strong performance for the company in the first quarter of FY20?
So if you see the last quarter of last year first quarter, there was a FVTPL expense which is not there. That was conversion of the CCPS share into the equity share. So I think that is there. Also, we have had a strong revenue growth. So if you see year on year, we have about 37% revenue growth, which is resulting into higher operating margin.
So now for the full year, that is financial year 2019, you did an EBITDA of close to 82 crore rupees, and in Q1 FY20 your EBITDA stood at close to 37 crore rupees. So is the Q1 number sustainable, and can investors expect such kind of numbers from the company going forward?
So EBITDA numbers generally are okay to take a guidance from, but I think this particular quarter is specifically very bumper quarter as against the revenue growth that you have seen in the last 4 or 5 quarters, which has been about 25%. This particular quarter has been about 30%. So I think if we take a revenue growth of about 25% and our historical cost growth has been about 17-18%, that's how the EBITDA should be calculated in going forward as well.
So something around 25 to 30 crore is what you can achieve on a quarterly basis going forward. That is what you're indicating here?
Yes, I think so.
Okay. And the EBITDA margins in this quarter was also at 25%. So is that also a sustainable level, or there are more levers which could push the margins upside going forward?
So if you see, EBITDA margins have been constantly improving as our revenue is growing at around 25% and as our cost is growing at about 17 odd percent. So EBITDA margin has been growing. Last year, the same quarter, EBITDA margin was 15%. Now there is one change in this year's EBITDA margin, because from the 1st of April, accounting standard has been changed and the lease rental cost has been amortized as the below EBITDA. So that is why you are seeing extraordinary EBITDA margin. Otherwise, if you see compare basis, it should come around 21-22%.
Okay. And any specific reasons why your other income was shows a sharp jump in this quarter compared to last year?
I think that is purely because of the cash and cash balance that is increasing on our, as you can see, last year we generated about 255 crores of cash on our balance sheet. So total we have about 746 crore rupees on our balance sheet. So that is resulting into higher realization from the interest income or from the bond income.
So coming to your cash balance, as you just mentioned that you have a cash balance of close to 746 crore rupees on its book, which is pretty high for your company. So how do you plan to deploy this cash? Can investors expect hefty dividend going forward, or will you be investing more of this cash in your business?
So I think there are 3 usage of cash that should be thought about. One, obviously we have adopted a dividend policy. I think in quarters to come we will do more certainty around what kind of dividend and how much dividend. Secondly, I think we will continue to look at cash balance accrual because of the for a company of our size, how much cash balance we need on our books. Third, we will continue to look at the SaaS opportunities and fintech opportunities for any kind of a partnership or investment or acquisition.
So any specific allocation that you have decided so far, that you need to save at least 30% to invest in your business, and the 30% will be given to as dividends to shareholders? Any specific allocation that you have made so far?
Not yet. We have become cash positive mostly in the last 2 years, and we are in the process of deciding what would be the best allocation ratio going forward, but not yet.
Okay. Also, over the years, you have seen a steady rise in your total number of suppliers on your website. But how do you plan to increase your paying subscribers more for your website?
So I think paying subscribers, there is a formalization of economy which is happening. So because of the GST, it is a lot more easier to find suppliers and lot more easier to find formalized economy supplier. That is helping. Two, we have about 1,200 people on the field sales force who every day meet different suppliers to acquire them for becoming a paying customer after they have enjoyed certain amount of freemium listing model. And three, there is a greater trend of moving towards online signing up and telephone based signing up. So I think all the three methods are helping in increasing our overall subscriber base.
Lastly, sir, what would be the key growth drivers for the company going forward in financial year 2020 and for the next financial year, that is FY21?
So key growth drivers in our case remain the two. One, number of subscribers, paying subscribers. So we have this quarter we have grown about 17% year on year in terms of paying subscriber base, and about 10% in terms of the average revenue per customer realization. Normally we have seen that our subscriber growth has remained between 15 to 20%, and our average realization per customer has grown at around 5 to 7%. So that should bring the growth going forward as well. We have also taken SaaS initiatives like lead managers, which is being adopted quickly by the suppliers, which is increasing the engagement on Indiamart platform. That should also bring some stickiness to the platform, thereby further reducing the churn.
Well, that would be all, sir. Thank you for speaking to Bloomberg Quint.
Thank you very much.